Hi everybody and welcome to today's lecture, Building Blocks and Core Concepts for Project Appraisal. My name is Danielle Fopp and I will be taking you through the introductory tools for economic appraisal. Now this lecture is vital before you move on to the following lectures on economic appraisal, because in this lecture we are starting with the basics. So before detailing the methodologies that allow us to perform a project appraisal from an economic point of view, it is necessary to understand a number of basic concepts. And we will begin with the basic economic concepts and build upon these in subsequent topics. Now, some of these concepts that you will need to be familiar with include cash flow, interest, and time equivalence. So we're going to start with cash flow, and some of you may already be familiar with this concept. The term cash flow refers to the net amount of cash and cash equivalents being transferred in and out of a company. Cash received represents inflows, while money spent represents outflows. Financial methodologies adopted in development appraisals use cash inflows and cash outflows as the basis of analysis. They focus on the amount and timing of cash flows. So will the money be spent at day zero, or will the money be spent in a year's time? And critical aspects are the estimation of future cash flows. So how much will we be spending and how much will we be earning? Validity is reliant on accuracy of estimates of cash flows, and we've touched on the nature of certainty and uncertainty previously. We know that cash flows generally for a business will occur throughout a year. So there will be money coming in and money going out throughout the year. However, for simplicity, in this course we will assume that they are occurring as a lump sum at the start or end of a time period. It's important that you realise that this is a simplified version of cash flow. However, it will help you really understand those core concepts of economic and financial appraisal. We will also take a look at this further when discussing time equivalence. And in the diagram on the screen, you can see that the cash flow has been drawn as a tap, where someone turns the tap on and more money comes out. So let's have a look at an example. We have a company, for example, and we know that the cash received signifies inflows and the cash spent signifies outflows. Same with if you have a job, when you get paid from your employer, you get cash into your bank account, and then when you spend that on clothes or on books or on a new phone, that is cash spent, which is an outflow. Now, cash flow is the movement of money in and out of a company. And just picture it like your bank account. Pretend your bank account is the company, and the cash coming in from your boss and the cash going out as you spend it on the weekend is the cash flow. Now, a cash flow statement is a financial statement that reports on a company's sources and usage of cash over a period of time. A company's cash flow is typically categorized as cash flows from operations, investing, and financing. And there are several methods used to analyze a company's cash flow, including the debt service coverage ratio, free cash flow, and unlevered cash flow. However, for the purposes of this course, we don't need to delve into them deeper. Now, contrary to what you may think, cash flow isn't the same as profit. It isn't uncommon to have these two terms confused because they do seem very similar. However, we need to remember that cash flow is the money that goes in and out of a business. So in the previous slide, they had the tap with the hose with money coming out, and that is not a full cash flow symbolization. It's money that goes in and out of a business. Profit, on the other hand, is specifically used to measure a company's financial success or how much money it makes overall. This is the amount of money that is left after a company pays off all of its obligations. Profit is whatever is left after subtracting a company's expenses from its revenues. Now we're going to delve deeper into the time value of money into the next topic. However, this is a topic that you really need to sit with and understand, so we're going to use this as a brief introduction. Now we know that the economic evaluation of a construction project involves the analysis of costs and revenues expressed in monetary terms, and these will occur at different times during the life of the project. For example, costs during construction occur at the beginning of the project, while costs for maintenance hopefully only occur 2 to 3 years into the project's timeline. Now, the time value of money is a core principle of finance, and it will be discussed in greater detail in the next topic. It helps us to assess costs and revenues which occur at different times in the life of the project. For example, the cost of construction versus the cost of maintenance in 3 years' time. How do we assess and compare those two given the 2 to 3 year gap in between? Well, how? We utilise interest rates. Now, to calculate the time value of money, we need to first understand interest rates. And this is because for a person or company lending money for a construction project, interest is compensation, in the main, for the loss of earnings which would have resulted from the lender using that money for an alternative use. For the developer, borrowing money presents an opportunity to start a project immediately, which would otherwise have to be delayed. The interest rate is, in essence, a measure which gauges the productivity we should expect from the project, or the minimum level of productivity expected from the use of the money over a given time frame. In other words, it sets the time value of money. And if you look at a home loan, it's exactly the same concept, except instead of a developer, you might have a family or an individual who's looking to borrow money from the bank. Now, the bank at no point in the history of banks will say, at time zero, I'm going to lend you 500 grand, and you can slowly pay that off over 30 years with no interest. Banks always charge interest. And why? Because they could put that money into their own development. They could put it into a long-term interest account. They could put it into a savings account that's paying interest. They could be using that money for something else. So we know that we need to look at interest when discussing the time value of money. And let's just close off here with a definition. So the time value of money is the concept that a sum of money is worth more now than the same sum will be at a future date due to its earnings potential in the interim. And we know that if we were given the choice of having 50 grand gifted to us today or 50 grand gifted to us in 10 years' time, we would all choose today, because even if we didn't need to spend that money immediately, we could put it into an account that was earning interest, and then in 10 years' time we would end up with much more than the 50 grand. This topic will be delved into further in the next lecture. So now let's have a look at interest. We touched on this with the time value of money, but it's worth jumping into a little further. The estimation of interest. It's the quantitative measure of the time value of money, and it uses the interest, which allows the difference between the amount of money originally borrowed or invested and the final amount owed or accrued to be calculated. The original amount invested or loaned is termed the principal, which we can now see on the screen. And we are going to assume that this is the timeline of a project starting from the beginning, time zero, so that would be considered today, to an undefined period of time in the future. So for both of the examples that we're about to look at, we are looking at time t0, which we will assume is today. So if an amount of money is invested at time t equals 0, and this amount has accumulated with time, what would the interest at time t1 be? So we don't know. And time T1 could be anything. We're not putting a specific year on it. We're using T1. Well, there's a calculation for it. Let's have a look. The interest at time T1, so this is the undefined time in the future, is the total amount accrued at time T1 minus the original principal at time T0. But what happens if we are borrowing money? Well, if we borrow money at time T0, so we go to the bank and we ask for money, the interest at time T1 would be the total amount owed at T1 minus the original principal. And as we can see, in both of these situations, the amount of money that was borrowed or invested in the first instance increases over time, and this increases above the original, and the increases above the original amount is called interest. Now, this interest can also be expressed as a percentage of the original principal per unit time and allows us to obtain the interest rate. So the interest rate as a percentage is the interest per unit time divided by the original principal times 100. And the time frame is the interest period that we are looking at. And this must be defined. So it can be 1 month, it can be 1 year, and it's known as the interest period. So when reading textbooks or readings, you may see a unit of unit time, time frame, or interest period. So now let's take a look at a concept called time. Now the concept of time equivalence brings together two of the concepts we have already looked at, which is the time value of money and interest rates. Now the concept of time equivalence implies that different amounts of money at different points in time are actually equal in terms of their economic value. We can also then use this to look at the earning power of money, and this helps decision makers to decide if money should be invested in a construction project, deposited in, say, a compound interest bank account, or kept in savings. Now, the concept of equivalence is central to the economic and financial analysis of construction projects, as it permits cash flows or different amounts of money accruing at different points in time to be compared at one common point in time. Let's take a look at the following example to help illustrate this point. We've got some inputs. Value at time t equals 0 is $1,000, and we know that the interest rate is 10%. Now, what's the time period? We have per annum, so that's per year. Now, at this point, you want to know, are we going to invest? Are we going to do this? What are we actually doing? Well, what will be the value of this $1,000 in 1 year's time? Not sure. What can we do to find out? Well, let's use the time value of money. So the first step is to calculate the interest accrued during the time period, and here it's 1 year. So we're using the equations we've seen previously. So if you need to pause and go back, make sure you've got them written down. We then need to add this to the principal, which is the value at t equals 0. Therefore, the equivalent value of $1,000 at t0, which is today, at time t1, which is in a year's time, is $1,100. So what does that mean for us? Well, $1,000 today has exactly the same economic value in this scenario as $1,100 1 year from today. Now, the time equivalence is of great importance to the economic appraisal of construction projects because it is so useful for the examination of economic viability of projects, and it also allows us to understand the equivalence which exists between different amounts of money paid at different points in time. And remember, this is the basics. We'll be building on this in the next lectures.